FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
We're back on the Financial Survival Network. It's Kerry Lutz, and we're thrilled to have Goldmoney's Alasdair McLeod with us now. We're talking about the most recent precious metals smackdown, which took place in the past 2.5 days, as well as that elusive silver fix, as well as the gold fix. Alasdair, welcome back. How are you?
I'm very well indeed, and very nice to be with you, Kerry.
Well, always a pleasure. So we had this little slam down that took place in the past 3 days. Of course, it's just normal market action. But if there was to be a conspiracy to keep down precious metals prices, why would such a thing take place in the past few days?
Well, when I saw it, I thought, I thought the boys were back doing their conspiring. But then I looked at the turnover on COMEX. Sorry, not the turnover, but the open interest on COMEX. Now, if they had actually come in and sold an extra 10, 20,000 contracts to depress the price, that would have been reflected in a higher open interest at the end of the day. But interestingly, the open interest was actually lower. So that tells me that it was actually good old-fashioned profit-taking. There were obviously some pretty big players there who were riding that run-up, if you like, the turn from that sort of 1240 level when it was becoming obvious that gold perhaps was bottoming out and it might have been worth a punt on the bull tack. So I think it was likely to have been genuine business rather than what we've all become so used to, the manipulation of the price of gold. And that actually is a positive, because if they were still trying to hit the price of gold at a time when the Portuguese banking system was becoming unstable, which, I was putting 2 and 2 together and getting 5, as I'm sure a lot of us were. I sort of thought, well, every time there's instability, then you can sell gold because they're going to hit it. But no, I think the open interest figure, it convinces me anyway that this was genuine profit taking. And therefore, if the Eurozone banking situation does visibly deteriorate, it's not a certainty that the price of gold will go down, having been hit. And I think the fact that it wasn't hit in the way in which might have expected it to be been hit, by official intervention, if you like, I would take that as a mild positive. And I think the ability of the authorities, if I can call that in the very general sense, to control the gold price, I think that is not as easy for them as it was. And there's also another point, which is, I know, slightly off topic, but is nonetheless relevant. I don't know if you saw, but the head of the Bank of International Settlements came out with a statement in the annual reports saying, basically, he didn't like the soft money options being pursued by the Fed, Bank of England, the Bank of Japan, and the ECB. It wasn't working since 2009 or 2008, when we had the Lehman crisis. What's happened is that public sector debt has increased by 20%, both in emerging economies and also in the mainstream advanced economies. So this hasn't cured anything. If anything, things have got worse. And he sees markets being horribly mispriced. Instead of the risk premia increasing, in fact, they seem to be decreasing, and that is bizarre. And I think that what he is doing is he is coming up with the sort of economics that I think you and I, Kerry, would understand, which is, if you like, Austrian or Hayekian economics, rather than the Keynesian economics. Now, this is very, very interesting, because I think it means that as far as the Bank of International Settlements are concerned, they must be moving towards reestablishing gold. I don't know how, and I don't know quite in what role, but reestablishing gold, if you like, as a backstop to the international financial system, because that is the logical conclusion of following what is increasingly being called a Mises and Hayekian bis.
Yeah.
policy. So it is, I think, very interesting in that sense. And I think that the desire of the authorities, if we can call them that, to intervene in the gold market to suppress the price is probably being undermined by the thoughts of the Bank of International Settlement and events generally. So, but quite where it takes us at this stage, it's too early really to say. And I think it would be too early to put an awful lot of credence on what I have said. But I think it is there in the background.
I read that, and at least somebody in a position that means something still has some sanity and still is grounded in reality and knows, because you just have to look around to know that this money printing has done no good other than to create bubbles in high-end real estate, in stocks, in financial instruments, in collectibles, in 8-figure paintings, things like that.
Yes, I mean, this was precisely Jamie Caruana's point. You have repeated almost exactly what he has said. And, I think that, it's interesting because Mark Carney appeared before the Treasury, the Treasury Select Committee in London. I think it was yesterday morning. And he was saying no to the Caruana approach, if you like, saying, well, of course, he doesn't have, an electorate. In other words, what Carney was trying to say is that this man is in an ivory tower. Now, hold on a minute. This is the man everybody turns to when they're in trouble.
Yeah.
He's not in an ivory tower. He is certainly divorced from the problems that Mark Carney and Janet Yellen and so on and so forth have. But by standing back and being able to say, look, from where I'm sitting, this does not look good, I think actually that's a very, very important controlling function over the whole thing, rather than criticism that should be ignored, which is at the moment, I think, what the governors of the central banks are trying to do.
Yeah, well, they've been out of control, Alasdair, for so long. And, they just refuse to accept the validity of the business cycle and their role in it.
I think that's true, but I would place a greater emphasis on the system has been out of control.
Yeah.
And anything that they do to try and control it is always sort of more of the same, which eventually ends up making the thing worse. And it's just, the phrase we had immediately after the Lehman crisis, I think is so apt. It's continuing to kick the can down the road.
Yeah. Yeah. Well, yeah. Amazing that somebody actually said the truth, and somebody whose word actually means something. What effect it will really have, that's a good question. And I guess we're going to find out. In the meantime, we've got Yellen basically, I love it, her testimony. Yeah, there's like PE ratios are not out of line, right? PE ratios, the stock market's fairly valued, right?
Yep. Right, tick.
Yeah. Right. That's a sure sign that things are out of control.
But to be fair to her, Kerry, what else can she say? I mean, basically, I didn't read what she said in detail, but the impression I got was that she was trying terribly hard to say nothing.
Yeah.
And I think she succeeded in doing that because some people have commented that she was saying that the economy isn't recovering as fast as it is, and other people were saying that interest rates are going to have to go up sooner. So I think, given the spread of opinion in the wake of her testimony, I think she probably achieved the objective, which was actually to say, sweet FA.
Yeah. Yeah, well, it's just mind-numbing that they get up there. And, yeah, the whole concept of central banking, well, we know where that's heading, and the amount of damage that they do, and malinvestment, and all sorts of other wonderful things that they've brought upon us. The real estate bust in the United States here, we still haven't recovered from that. They'd love to project, an aura of normalcy and recovery, but, new home.
Well, all the statistics that are produced are completely rotten.
Yeah.
And it is amazing to me that markets actually pay any attention to them. They do seem to.
Yeah, well, they follow the money.
Well, I think that's probably right. Yes.
They follow the money, unfortunately. And, until the next crash. And that was the other thing the BIS said, is that, we're heading for the next crash, basically, right?
Yes, absolutely. And that was the point, about the increase in debt since the Lehman crisis. If any medicine was going to have any effect, it would reduce the dangers of too much debt. But we've ended up with more debt, and I think that's the way that Caruana put it, and that's totally in accordance with what you've just said.
Yep. And hey, when we get back, let's talk about the new replacement for the silver fix and probably for the gold fix as well on the Financial Survival Network.
FSN Radio. It's all about what's next.
When your accountant wants tax-free income, this is what he does. Accountants know the law. They also know that any American could legally get paid up to 3 times per month, 100% tax-free. That's 36 tax-free checks each year. It doesn't matter what you make already. This simple strategy could work for anyone. Go to www.irsrevenge2.com to learn how. That's irsrevenge2.com.
The Financial Survival Network. It's all about what's next.
We're back on the Financial Survival Network. We're talking with Goldmoney's Alasdair McLeod. So, Alasdair, you're there in London where the daily silver fix takes place, where the twice daily gold fix takes place. All right, they're going bye-bye. But from my understanding, all of these derivatives contracts, and we don't know how much there are because there's probably over-the-counter derivatives that probably don't even get traded on the exchange. I mean, it's a big wild card, and now they're proposing a substitution. What's going on here? First of all, you better define what the fix is for those of you out there who don't understand it, and tell us what's coming down the pike here.
Yeah, sure. I mean, the fix is something that has happened for a very, very long time, and in the case of silver, it's once a day at noon, and that's going to cease very shortly because there are no participants. And gold twice a day, once at 10:30 in the morning, once at 3 o'clock in the afternoon. Now, if you bear in mind that these markets are over-the-counter markets, in other words, there is no recording of transactions. Transactions are a private treaty, if you like, between the bullion banks and other participants in the market, between participants in the market and public funds and all the rest of it. What people like to have, and this is whether you're, doing the accounts for your gold mine, or whether you're running a fund which has got exposure to gold or whatever, you want to have a reference price. So that, in a sense, is what the fix provides, not only in gold, but also in a number of other markets. Foreign exchanges, I understand they have a fixed process as well, and also the infamous LIBOR. The difference perhaps between these and gold and silver is that gold and silver actually trades on the fix. And the way it works is that the participants come in and they will have open telephones with all their clients. They will also be dealing for their own books. And in the fixed process, the price of gold is fixed when they get within 50 bars, that's 5,400-ounce bars, of balance between buyers and sellers. So unlike an auction, sort of an open auction, as it were, when you put your bid in, you can actually withdraw it. You can withdraw it as the process goes on, and you can put in new bids, whatever. So in theory, it is this point where there is maximum liquidity in the market. Now, the trouble is that if you're going to distort the market by bringing business forward into the fix, which might otherwise have occurred at an earlier time, or vice versa, then you're going to have the possibility that it can be gamed. And indeed, Barclays were caught just doing that.
Right.
Trader has been banned from trading in the city again. And not only that, but Barclays were fined quite heavily. Now, I think it would be wrong to say that it's continually abused. I mean, the only thing I would say is that between the year 2000 and the year 2010, which covered most of the bull market when gold went from under $300 to up to, I think at the end of 2010, it was around about the $1,200, $1,300 level. if you had sold gold on the morning fix at 10 o'clock in the morning and bought it back in the afternoon, you would have made over $600 per ounce. You've done that. Now, I know that quite a lot of gold, I think something like 7 or 8 tons of mined gold, in theory, comes into the London market every day, and so on and so forth. But that should be discounted. And it does seem to me that the process of fixing does actually distort the market, because that sort of distortion shouldn't happen. Looking at this perhaps from another angle, which is actually, I think, probably the important angle, is that the London gold market in its current form was born out of something that we call Big Bang. And that was basically when the City of London changed from self-regulation into, the stock exchange, for example, became regulated by I think it was in those days, it was the SFA, which then became the FSA. And a decision was taken as to what was a regulated investment and what wasn't. Now, gold mines and derivatives and things like that were quite plainly regarded as regulated investments. But physical metals, including bullion, were not regulated. So we had a situation where the regulated markets, if you like, developed with the regulator's blessing and the regulator insisting on minimum requirements and all the rest of it, whereas the metals, and in this case, the precious metals, developed without any regulatory interference whatsoever, other than the steering hand of the Bank of England, who basically was ringmaster to the whole thing. Mm-hmm. So, in a sense, the market we have today dates back to the mid-1980s. Now, since then, we've had developments in physical markets. I would just draw your attention to China. The Shanghai Gold Exchange is a proper trading exchange. It trades only in bullion. The derivatives are separated out into another market, the futures market. And the gold exchange makes returns, daily and weekly returns of turnover and deliveries. Mm-hmm. Now, we don't get that information out of London. So immediately you can see that the standard of information coming out of the London market is not fit for modern purpose. And this is important because if London is to retain her position as a major gold trading centre, then she is going to have to smarten up her act. The people in the market don't actually take this view, and I can sympathise with this because they've been making a lot of money out of gold trading and all the things that go on the back of it, and they have developed some very, very sophisticated techniques. And it has earned this country an awful lot of money. I mean, to be the center of the global center of gold trading, physical gold trading, is extremely lucrative, apart from anything else. So you can see that people in the market, members of the LBMA, actually think that A, they've done nothing wrong, and B, therefore, there is really no need for change, or if there is any change, it should be minimal. That's not going to happen. Basically, the politicians are beginning to get their teeth into this. The Financial Conduct Authority, which is the new regulator for London markets, has had a flea in its ear from the Parliamentary Treasury Committee over the gold market. And you can bet your bottom dollar that this isn't going to rest. So I think that the whole market is going to evolve. Now, coming back to the fix, specifically, the fix's problem started with Deutsche Bank. Deutsche Bank was being investigated by its own regulator concerning all its precious metals dealings. The regulator in Germany is called BaFin, the Bank Financial whatever. Anyway, BaFin is what we all call it. And it may have just been coincidence, but at about the time that BaFin requested all the details of all the dealings that Deutsche Bank had entered into on its own book and also for its customers, at that point, Deutsche Bank announced that it was resigning the silver fix and it was putting its gold fix seat up for sale. Now, this is the interesting thing. If you are a member of the gold fix, then you can make an awful lot of money, basically because all that business, the big depth of the market at those two fixing times, gets channeled through the fixing members. So it stands to reason that you can make an awful lot of money. But guess what? Nobody wanted to buy it. Uh-huh. And this is a very surprising thing. And the only conclusion one can come to is that the in-house legal advice for all bullion banks who might have been in the running is don't touch this with a barge pole.
Yeah.
which is interesting. And I think that point alone is actually being missed by the World Gold Council and the various people who are trying to find a replacement for the fix. They're sort of trying to say, well, look, there's an interruption in business, but if we can resolve it, then it's business as normal.
Yeah.
I don't think that's going to occur. So anyway, that's my full take on the situation there. I'm sorry it's a bit long-winded.
Yeah, that's okay. And I'm glad that you brought us up to date on it. It's a lot of things that I didn't know about, and I'm sure many of you out there didn't have a clue about either. But you need the fix as a reference price in all of these derivatives that are out there, all the derivatives contracts, Alasdair, right? Am I correct in that?
Well, the point is that when you have an over-the-counter market, which is what LIBOR is, which is what FX is, then you do need to have some reference point. I mean, because the accountants wanted a problem, anything else. But I mean, the answer is that the London bullion market must no longer work as an over-the-counter market. Yeah. I mean, that is the way to cure it. For example, on COMEX, I can get the equivalent of a fixed price. I just look at the official closing price on COMEX. It's recorded, and thank you very much, CME. Bang. Yeah. So this is not a huge problem. It is a problem so long as you have an opaque market. The answer is to make the market absolutely clear and visible to all.
But the problem is all of these derivatives contracts for silver and gold that are traded on the COMEX and I guess on the London market all reference that fixed price. Okay, they all reference it, and now that price isn't going to exist. So what happens to those contracts, Alasdair?
Well, basically, the COMEX contracts, their value moment to moment depends on the price of gold, and it's 24-hour trading around the world. Yeah. In London, we're just going to have to open up this market. That is the only answer.
But the existing contracts, there's a definition in those contracts, and it specifically references the London fix in the silver contracts and in the gold contracts. I think this is potentially a legal problem that what happens, because you can't just change horses midstream and come up with a new fix.
I think, Kerry, you've got a very good point.
I think this is a meltdown here.
Yeah. Well,
I think potentially.
It could well be.
Yeah. Even COMEX they don't use the closing COMEX fix, according to Bix, and he's got a 2005 document from the ISDA.
Yes, the ISDA.
Yeah.
ISDA.
Yep. And the terms in there, for the price, use the London fix for silver and for gold, which is kind of freaky because those aren't going to exist anymore, except they're going to come up with some type of substitution from CME and Reuters. And we're in uncharted territory here. So it's going to make it interesting.
Yes, it is. You're the lawyer, Kerry, but I would have thought that the way this is likely to be resolved is that ISDA would rewrite the rules.
Yeah,
because ISDA basically is the body that effectively oversees and coordinates the legal side, the contractual side of over-the-counter markets. Yeah. So I would have thought that the starting point is that something will happen there. I mean, there is precedent for this sort of thing happening before. An assumed facility in a market. Either being radically altered or disappearing. And ISDA does respond by amending, after lots of consultation.
Yeah, well, for new contracts, for existing ones,
yes, could be exactly.
It could be impossibility to perform. This is where the lawyers make their money.
I think that's absolutely. I think there is another aspect which is probably more interesting in a sense, certainly more interesting for a wider public.
Yeah,
and that is that by opening up the market in London, if that does actually move from being over the counter into being a proper recorded market, with market makers, if they're going to be market makers, they have to make a price all the time in a minimum quantity of gold, minimum quantity of silver, minimum quantity of platinum, and so on. If it's going to be like that, then I think that the net effect will be to attract a lot of investment interest, which otherwise wouldn't have existed.
Right.
So, and that investment interest is always, when it comes from the public, is always on, well, initially anyway, always on the bull side. So I think that this is another thing we need to factor into our thinking. If we're sort of holding or buying gold because we think there is an increased systemic risk, or we think that there's a bull market about to start again, and all the rest of it. I think it's very, very important when you're trying to judge the pace of it. Bear in mind that over the next 2 to 3 years, as the London bullion market evolves into something more transparent, this is likely to increase interest in precious metals.
Hey, and the other thing, of course, is that the Rothschilds got out of this how many years ago?
Yes, I think that was about 2004. That to me was always a bit of a mystery. I'm not quite sure why they did it. I mean, whether it was just some sort of decision they took, or whether some far-sighted person in the partnership sort of thought, we don't really like the way this is going. I think it's quite possible that because the people over the years I've met from Rothschild at the top, do take a very sort of I don't know. I mean, they will look at the participants in a market and then decide whether they want to get involved. That's one of the considerations they will take. And it could well be that through their fixing, running the fix up until 2004, 2005, they were seeing the character of the market changing, the players changing. They probably thought, but it's possible that they thought this is a market which we no longer want to be involved with. So, I mean, I don't know that. I'm speculating that's the case, but that would be pretty consistent with the way that great house runs its affairs.
Yeah, so they saw the handwriting on the wall that far back, and it was pretty faint, perhaps.
Yeah, possibly.
And then it was, okay, it's time. And it's amazing they could see it that far in advance. But I guess they knew something the rest of us didn't, huh?
Well,
perhaps.
do you know, Kerry, in all the years I've been in the finance industry, I have met people who actually do take that sort of decision. They take a strategic decision, not on the basis of the immediate P&L, but on the basis of, is this a business which long-term is going to give us risk? Because if you get the wrong sort of people coming into a market, you're going to be counterparty to those people. So it's actually quite an important decision. And I have known over the years people who do actually look at that aspect of things and have it, if you like, not necessarily the sole factor in a decision as to whether to participate or not, but a very, very important factor in a decision as to whether to participate in a market.
Yeah, that's interesting. And, if all businesses took the longer term view instead of the quarter to quarter view that's prevalent, especially in the States here, we would be better off. I mean, Alasdair, I don't know if it's going on in Europe to the extent it is in the U.S., but these share buybacks where, the tax laws make it so attractive to do it, especially if you're paying a dividend where you basically can just borrow the money for next to nothing now because of the zero, because of ZERP, and you pocket the dividend, and your dividends are after tax disbursements. So, then you pay the interest pre-tax, it's tax deductible, and the logic of it. And then you increase your per share earnings, even though you haven't increased your revenues, and you look like a hero, even though your company is weaker, your balance sheet is weaker. But these analysts don't seem to look at balance sheets anymore, Alasdair.
Kerry, I'm surprised you haven't said the beneficial effects on the share price for management's share options.
Well, yeah, that too, of course.
Which I would have thought is a very major factor in all this.
Well, that's the only major factor, I think.
Well, this happens a lot in America. I think it is happening in Europe, but not on the same scale as seems to be reported in America.
Which will lead further impetus for the eventual debt jubilee when it occurs.
Yes, yeah. Exactly. All this increased debt we're coming back to where we started, really, with Jamie Caruana. since Lehman, the amount of debt has gone up 20%. So, have we cured anything? No, we haven't. And everything we do seems to be accelerating the pace of debt creation.
Yeah, and the debt is okay when it leads to greater profits, and when it's used to build for capital expenditures that are going to increase profits, at least the potential for it. But here, this is just financial ledgerman. It doesn't really help the company any.
Yes, that's right. Absolutely. And, I think also that, consumers borrow on the basis that they will never have to repay. Governments certainly borrow on the basis they will never have to repay. Debt is only good if you actually plan to use it wisely. And in that plan, you have to incorporate estimates and realistic estimates of cash flow so that you can pay the interest and you can also repay the principal at the end.
Yeah.
And that's so old-fashioned. I'm afraid that Dickens, I think, was the last to talk in those terms, more or less.
It's absurd, and it's all going to lead to no good, and it's all going to blow up in the end. I'm afraid, Alasdair, just like Mr. Carawanda said, these are not sound business judgments made for the long-term viability of the business. They're just not. No. They're made for short-term, selfish reasons for the most part, and to the detriment of the company, whether it's Apple or IBM or any of these companies. And the more of a dividend you pay, the more profitable it becomes to engage in this kind of activity.
Exactly.
Yeah, well, on that note, Alasdair, tell us where we find your writing again.
Yes, at goldmoney.com, and also it's repeated at financeandeconomics.org, which is my own website. Mostly I write for Goldmoney. Just occasionally there's something I don't write for them, which might appear on my website, probably because it might be not quite suitable for Goldmoney. Sure. In that we do nurture our market relations terribly carefully. So we just make sure that what we say is level-headed and all the rest of it. Not that things are not level-headed on finance and economics, but I have a little more latitude.
Understood. And of course, look for the links on financialsurvivalnetwork.com. Don't forget to sign up for the newsletter. If you want to support the show, go to clubfsn.com. All contributions greatly appreciated. Alasdair, we will talk to you again soon.
That was my pleasure. Thank you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.